Well, good afternoon everyone and welcome to the New South Wales Dairy Business Outlook presentation, brought to you by New South Wales Department of Primary Industries in cooperation with Dairy New South Wales and Dairy Australia. I'm Kerry Kempton and I'll be your host for the next hour or so. We've decided to use the webinar format today to, I guess, counter the tyranny of distance, to reach out to the whole of the New South Wales industry and beyond. So I hope this format works for you. As you can see, there's a help number on the side if you're having difficulty getting audio. And also, if you have any questions as we go along through the presentation, you can type your questions into the box on the bottom left-hand corner of your screen. So we've got a very full program today, and we'll try to get to questions at the end if we can. Now, before we start, I'd just like to do a quick poll of our audience. So you should see a question on your screen about where you're located. So if you could click the button relevant to where you're located, and it should come up live as to where people are. So we'll just give another 5 seconds for that and then we'll close that off. Okay, thank you. So we've got a good spread of people across New South Wales by the look, plus quite a percentage of people outside the state. Just a second question, if you wouldn't mind just telling us what your role is in the dairy industry, whether you're a dairy farmer, a service provider, a government person, or another. So I'll close that off in 5. Okay, thank you. So we've got majority of service providers and government, but also some farmers on our audience. So thank you very much. We'll close that poll and move on. Today is about presenting the results of the Dairy Farm Monitor program. And our first speaker will be Amy Bellhouse from Dairy Australia, who's going to provide us with some context and some information about current situation and outlook within the dairy industry. Then I'm going to present the results of the New South Wales Dairy Farm Monitor Report for 2014-15. My role is Technical Specialist with New South Wales DPI. And then our third speaker will be John Mulvaney, who will provide us with some insights into the importance of business analysis and how to make good use of the data. So I'll now hand over to Amy Bellhouse.
Thank you, Kerry. I produce, as part of the analysis team here at Dairy Australia, the Situation and Outlook report 3 times a year. The most recent report came out about a month ago in mid-October. I'm just going to have a very quick run through some of the highlights today. The full report is available on the Dairy Australia website if you want to have a closer look at any of the detail or the charts. Sorry, I'm finding it impossible to change to the next slide.
Sorry, Amy, I'll just need to click on the PowerPoint and that should help to move it to the next slide and to activate the keyboards again.
Okay, yeah, thank you. Sorry about that. Just taking a look at Australian milk production to start with, we saw quite strong growth nationally throughout last year, up to just under 4% across the whole of Australia for the 14-15 season. We had initially been forecasting around 2% growth for this current season, 15-16, but looking at that, probably, if anything, got a little bit of downside risk now in terms of the hot, dry weather and the El Nino weather system we're experiencing. 2% would bring us about 9.9 billion litres for the total year, and at the end of September we were looking at being up 3.1% across the country. In terms of what's going on for New South Wales, strong growth last year, recovering out of the 2013-14 season, which was a real struggle for many, and growing strongly at the start of this current season, 15-16 as well, up 4.6% in total for New South Wales. But again, you see that growth curve in this black line here starting to taper off as well as the seasonal conditions start to bite. And just looking at where that growth can be apportioned to around the state, 2.5% growth in the inland central region, so that's 1.6 million litres, 4% or 6.1 million litres in southern areas, and north coast is a 7.3% growth, 6.1 million litres. Having a look at the Australian domestic market, it's been widely attributed with, I suppose, softening the path back of really depressed international dairy prices that we've seen in recent times. And this just looks at national performance of supermarkets. Milk growing at about 1.5% year on year in volume terms and 1.2% in value, so that's reflecting a slight decline in per litre pricing in the milk channel. Largely driven by UHT and fresh flavoured product, and also seeing a shift to full fat away from reduced or no fat milk products. Cheese, again, an increase in per kilogram or unit pricing, up 4.4% in volume terms, slight decrease in sales, and that's partly around changes in packaging formats, so less block cheese, more pre-sliced or shredded cheese, and also more of your specialty type cheeses as well, so those higher per kilogram value products. Within the dairy spread, seeing quite strong growth there. That's been performing well for a while, largely driven by sales of butter, and you can see as well an increase in the per kilogram or the unit pricing of the product as well, with value growth quicker than the volume growth. And then looking at yogurts and snacks, you can also see a trend, I suppose, to some of those more products that are perceived as perhaps a little bit more natural. So more sales of unsweetened, plain or Greek type yogurts at the expense of declining dairy snack and dessert type product sales. So total year-on-year growth has been negative, slight decline 1.4%, but value growth of 4% over the same period. So again, demonstrating an increase in the per kilogram or the unit pricing of the product. Looking at the international picture, commodity prices, there's a few sort of key supply and demand shocks I've picked out that have impacted on the global scale in recent years, just demonstrating the volatility of those global markets that we're exposed to. So there's several shocks there on the supply side which have helped to push prices in either direction in recent years. So global supply surges in response to increased prices in, say, 2011 and then again in 2014 coming out of those lower prices. But also droughts in the US and New Zealand, which helped to reduce supply and push prices up. And buying activity by major purchasers as well, such as China and Russia. Russia having banned most of their major Western suppliers in August of a little bit over a year ago. Looking at other things like the post-quota effect in the EU, with markets looking at expecting a surge of growth out of there with the removal of their dairy production quotas. And more recently, things like production out of New Zealand and reduced offerings on GDT, helping some improved sentiment to drive a bit of a recovery, but that's then fallen away again in more recent weeks on GDT, and we'll have a little bit of a further look at that later. So here we are. Commodity prices, I said whole milk powder sort of starting to come unstuck. We've seen a little bit of an increase over a few auctions in the average whole milk powder price on global dairy trade platforms. But then in the last few auctions starting to come off again, and that's really just demonstrating that there is still a lot of product out there. There's a lot of product coming out of New Zealand, for example, and in skim milk powder there's a lot of product out of the EU. So I said that sentiment-driven recovery in the market, making things very volatile as that changes. And just looking at some of the other things, the supply fundamentals are really mixed. We've got Europe powering ahead, responsible for half the growth in the first 6 months of this year globally in milk production, so that's 400 million litres of extra milk coming out of the EU. New Zealand production is tightening, that's starting to come through in the figures now. US has had a very, very strong domestic market which helped encourage their continued growth. Yeah, Australian sellers have been remaining fairly cautious, particularly with the weather pattern we have going on. But sentiment is fairly bearish. You know, we're coming into the New Zealand peak season, got an apparent contradiction of the forecast supply shortfall. European sellers are keen to move product. We've got some really competitive offers coming out of the EU and going into areas that are traditionally seen as Oceania-dominated markets, such as, say, Southeast Asia. And the big buyers remain quiet. They're well stocked up. Just looking at some of the things that are going on in a global context, some pictures from the news recently here about what's going on in Europe in response to the tightening farm gate prices that they've been experiencing. They do have a private storage aid program that's looking for further assistance in relation to the margins that they're seeing in milk production. US production, as I said earlier, really boomed as their domestic market defied gravity. Their production growth is now starting to slow, but that means we're seeing some increased export offers as well as markets have come back up and come more in line with the US, and their margin situation does remain fairly good. Just looking at what what's been partly driving those situations, particularly as I mentioned the EU. Farmgate prices are well down in year-on-year terms for all 4 of the major dairy exporters globally. So Australia down 6% on average, the US 33% down, the EU down 16% and New Zealand 13%. So significant drops there, and as I said, the Australian market has really been insulated by a few factors, one of which has been a strong domestic market. There's also been currency and manufacturer as the product mix decisions. But the domestic market strength has been one factor helping to insulate us there, and as you can see, we're actually doing relatively well in global terms. Looking at global supply and how that's responded, it's still expanding, really in defiance of those depressed global prices that we've been looking at just before in the chart. This chart here shows the relative size of the world's 4 largest dairy exporters, so not necessarily the largest producers, but the largest exporters of dairy. In terms of New Zealand and the EU, here you can see the two largest exporters. Just under 3% growth for New Zealand last year, and they're forecast to shrink anywhere between 3 and 10% in their current season. EU expecting slow and steady growth as per last year. The US, again, similar, probably around 2%, and then Australia here as well, probably a little under 2% for the year. So the real story to take from there is that milk production is still expanding globally. And we've got Europe and New Zealand vying for a share in key markets. So this shows volume export changes from the major exporters in the 12 months to June. You can see that the EU up 5% in terms of their exports, Australia up 7% and New Zealand 3%. So all pushing out increased volumes of product with an increased expansion in production. And the United States are down 8%, and that's coming back to the issue of their strong domestic markets that they've had, reducing exports, keeping some pressure off the global market in that sense. And just looking at global demand, the other part of that picture, I've said here it's a bargain hunter's paradise. So looking at the major global markets by volume, and these are global exports to these markets, not just Australian. But Southeast Asia, very price-sensitive market, you can see that their exports picked up strongly. They grew about 10% in the 12 months to June, making the most of the cheaper priced product and milk powders to stock up. And Africa as well, a quintessentially price-sensitive market, really making the most of the opportunity to snap up some cheaper priced dairy products as well. And those countries have to some extent helped to keep a bit of a floor in the market, while demand from some of the bigger buyers has been weak. They've been able to take the opportunity to come in and buy some product while they can afford it and make the most of that opportunity. So the demand's there, just that they weren't necessarily able to buy that product at the top of the market when it was more expensively priced. The Middle East have been pretty steady. They bought hard up until about February, but then their supply pipelines were full, not in a position to keep buying as strongly. And then you can see Greater China, the big fall off in their dairy imports, which have been, everyone's been talking about in the news and in the impact that that's had on global markets. Some good news there, though, for Australia has been a large drop-off in that total dairy exports to China has been milk powders. And one product for Australia, liquid milk, so largely UHT, has continued to, we've increased our exports to China significantly throughout that period. So there's been some good news for our export industry, even despite that apparent large decline from China that's been depressing global markets. Japan, Australia's largest market in value terms and our second largest in volume, their strongest growth in 12 years that they had in the 12 months to June. They're a very big cheese market for Australia. About 84% of what they import from Australia in dairy products is cheese. And Australia's total dairy exports to Japan increased 17% over the 12-month period, so going strong there. Russia, I mentioned earlier, banned most of their major Western suppliers for dairy products, and you can see the big fall off. They've had a 71% decrease in their dairy imports. And Mexico, the world's second single largest market for dairy since Russia has been largely absent. They take a large amount of product from the US, also increasingly from the EU and New Zealand, but a significant global market is not so much for Australia. So that's bringing me close to the end of the presentation. In terms of what's ahead, I've said here the market will remain key. For those supply and demand issues that we've been touching on, the fundamentals are not in balance. Global supply continues to grow, even as that is slowing, and the demand is still remaining relatively weak on a global scale. So the increase in international prices we've seen recently could be out on a bit of a limb, and we've seen in the last few GDT auctions that it was largely sentiment driven. So it's just about proceeding with caution. We're going to see volatility for a while in those markets. The Australian market continues to perform well. Domestic markets, supermarkets that we looked at only make up a portion of that, because we also have things like food service and other channels of selling dairy products, say milk bars and service stations, those sorts of things. That's performing strongly, and that's helped to insulate us somewhat, but it's just important to remember that Australia does remain exposed. Roughly 40% of our total production of dairy products is exported, so 60% domestic, 40% exported. And the underlying trends in that domestic and export market really remain unchanged. So coming back again to that supply-demand imbalance issue, and looking for that to come back into balance before we can really see a return in global prices to more average levels and a more steady return. Seasonal conditions in Australia are going to be key as well. As I said, looking at this El Nino weather pattern, hot, dry weather, and starting to bite and have an impact on production growth already, and seeing how that played out for our own production through the year. So thank you. That brings me to the end of my presentation. My details are there. And as I said, you can get the full situation and outlook report from our website as well. I'll pass that to Kerry.
Thank you, Amy. I'm now going to talk to you about the Dairy Farm Monitor project, for which the results are now just about to be released and will be available on the Dairy Australia website. So New South Wales DPI manages this project for the New South Wales dairy industry. The Farm Monitor project, it does a complete financial and physical analysis of the dairy farms in the project, and the purpose of it is to provide industry and government with high quality farm level data to help with decision making. As I say, we're jointly funded by DPA and Dairy Australia, and we're also strongly supported by the Department of Economic Development, Jobs, Transport and Resources in Victoria, which used to be the DPI, and they do the analysis for us. So we're into our 4th year this year, and so now we've got some trends emerging in our data for the 4 years, and this year in our report we'll report on the historical performance over those 4 years. This year we have 37 farms in the project, which is an increase of we had 30 last year, so we've had 9 new farms join in this year and 2 farms not continuing. So 37 farms represents about 5% of our industry in New South Wales, so it's a good sample size. As you can see from the map, we have they're the general locations of our farms, so we cover the state. We have 20 farms in the north region this year and 17 farms in the south region. We think we're probably dealing with the sort of top half of the industry with the farmers we have in the program, but so it's not necessarily representative of the whole industry, but there's a large variation between farms within a region and also between the regions. So I'm just showing you the method that we use to analyse the businesses, and we provide them with a profit analysis. This is just to show you where our numbers come from. So we start with a farm at the beginning of the year with their assets and liabilities, their equity and their debt. Then we work through their income, and income's made up of milk sales obviously, but also some non-cash income items such as changes in feed inventories and livestock trading profits. Both of those two things were very healthy this year, with good seasonal conditions and really strong beef prices, so which boosted cull cattle prices. So these inventory changes help to boost profit on farms. Then we move down into our costs. We start with variable costs, which are the cash costs related to herd, feed and shed management. Then we take off our cash overhead costs, which are repairs and maintenance, employed labour and admin costs. We've also got non-cash overheads included in our analysis, which are imputed labour valued at $25 an hour and depreciation of plant and machinery at a rate of 10% average. So this gives us our earnings before interest and tax, our EBIT or operating profit. And if we divide our EBIT by the value of our assets under management, we get return on assets, which is a key measure in the program. And that's how we determine the top 25% farms that you'll see when you go into the analysis. Then when we deduct interest and leasing costs, we're left with net farm income. Now, net farm income is the number used to create return on equity. So net farm income divided by equity gives us a return on equity. So what's left after that is available for operators' allowance or for growth, reinvestment into the business or investment elsewhere. So that's how we do the analysis, and you'll see some of these terms coming up in my next slides. Just to set the context for the 2014-15 season, milk prices were up this year against the trend, I guess, of the Australian industry that Amy's pointed out. So we've had an increase of about 3% in milk price to $7.46 per kilo of milk solids. Our concentrate price dropped a little bit this year, but it was still reasonably high at $370 a tonne as fed. That gives us a cost of production on average of about $7.12, which is very similar to the cost of production from last year. As far as seasonal conditions goes, as you can see from that map, the majority of our dairying regions had average or above average rainfall, particularly along the coast in this year. However, that rainfall wasn't always effective in that, in most regions we had a fairly dry spring, then a reasonably good summer and a reasonably good winter, but a very wet autumn, and several regions experienced floods. Now, to show you the physical characteristics of the farms that are in our project. I'll go through the state numbers, but you can see here the numbers for the north and the south region. So our herd size, which is determined by how many cows were milking in the herd for at least 3 months. So that's how we determine herd size. 338 cows. I've mentioned fairly above average rainfall. Our average farm size is 287 hectares with a milking area of 128. Our milk sold per cow is 506 kilos of milk solids, or around 7,000 litres a cow, which is very similar to last year. With our good season, our pasture utilisation increased this year by about a tonne of dry matter per hectare to about 8.3 tonnes, with a combination of pasture grazed and pasture conserved. Now, a lot of that increase has come in conserved pasture, which is up this year and indicative of farmers being able to conserve more feed with the better season and replenish feed stocks. I've mentioned our concentrate price, and you can see there's quite a differential between the two regions of about $40 a tonne. Now, this includes all concentrates brought onto the farm, so grain plus protein meals plus additives, and that's an as-fed cost. Our purchase feed per cow averaged 2.6 tonnes of dry matter per cow. Now, that includes purchased fodder as well as grain. The concentrates alone averaged 2.2 tonnes of dry matter per cow, or around 2 tonnes as fed. If we look at the financial results for the state, this shows you the asset values of our farms in our project, and as you can see, quite high asset value. That equates to over $22,000 per hectare invested in our dairy farms. Average debt is $1.5 million. Equity is healthy at 76%. You'll see quite an increase in the EBIT and the net farm income this year over the previous year, and return on assets and return on equity have increased as well. So indicates a good profit return for our farms this year or in the 2014-15 year. If we look at the difference between the two regions, you can see there's quite a significant difference between the capital structure and the profitability in the two regions this year. The nature of our sample, the south farms do tend to be larger with more land and more cows milking. They've got very strong profits this year, both their EBIT and their net farm income after debt servicing, and strong return on assets and return on equity. The north regions had a big improvement over the previous year as well. This graph shows the spread of return on assets across all our 37 farms, with the green bars being the northern farms and the blue bars being the southern farms. You can see we've got quite a big range, with a couple of farms with a negative return on assets, right up to our most profitable farm had a 17% return on assets. But the majority of our farms lie between this 0 and 5% return on asset, with the average, as I mentioned, being 3.5%. The top 25% of farms across the sample based on return on assets, however, had an average of 8.1 ROA this year. This graph shows the historical performance of return on assets across the 4 years of the project, and also across the regional groups. So we can see the trends over the 4 years. As Amy mentioned, 2012-13 was probably a low profit year right across the industry. It particularly was in New South Wales, a very tough year for milk price and for season. And you can see there's been recovery since then, but the recovery's been slower in the northern region than it has been in the southern region. Return on assets is one measure of performance, but it's obviously affected quite significantly by asset values. So the other performance indicator that we like to look at, and that John will highlight in his talk, is what was the profit or the EBIT per kilo of milk solids produced across the farm, so per unit of output regardless of farm size or per cow production. And as you can see, the statewide EBIT this year was very healthy at $1.32 or 10 cents a litre. But again, it reflects the difference between between the regions. So quite high in the south, $1.91, quite positive in the north at 82 cents, but a differential between the two. So you're all grown because this slide is quite busy, but I just wanted to highlight where that EBIT was generated from, or where the profit came from. So this graph just shows the breakdown in income and costs and how we end up with EBIT. So I'll just run through the state ones. We had that milk income that I've talked about. That other income boosted the gross farm income to $8.44. Then we have our variable costs, the main ones of which are feed costs, to get our total variable costs. Then we have our overhead costs, both cash and imputed, to give us total overhead costs. And this is how we calculate cost of production. So in our terminology, this is where cost of production is derived. So in our terminology, this is where cost of production is derived. Variable costs plus overhead costs give us cost of production. Our gross farm income minus our cost of production give us our EBIT. So you can see the cost of production there was $7.12 or 51 cents a litre, and then you can see the difference between the two regions. Now the difference between the two regions is spread across the whole cost structure, so it's not just variable costs or not just overhead costs. So it takes a fair bit of more delving than we've got time for here today to really tease out the difference. But you can see one of the key differences is the cost of homegrown feed between the two regions, and the other difference is the cost of labour between the two regions. The other point to mention is that there is a big spread on individual farms. So the previous slide showed you the averages for each region. Now this shows you each farm and their EBIT per kilo of milk solids. So you can see there is quite a large spread. These bars with the stripes are the top 25% farms based on return on assets. This bar here is last year's average. So you can see that this year's average, which is that orange line there, red line there, is quite above last year. However, this is the line for the top 25% performers. And the same for the north, for the south. There's quite a large variation across the farms. So it's hard to define also what separates the top 25% out from the others, because there's different factors, I guess, with different farms about what affects their performance. But what we intend to do is to work with some of these top performers to further, link their farm performance to their decision making on farm and find out what's driving these higher performers. So just in summary, 2014-15 was a profitable year for the New South Wales dairy industry. Production was up, profits were up. And that's on the back of above average rainfall, higher milk prices, higher cattle prices, a build up of feed inventory. So, and costs of production were lower this year than they were the previous year. So all those factors combined to create good profits for the farmers in our sample. So what's the outlook for the year currently? Milk price has come back a bit from last year's price, with the south region likely to be more affected than the north region. as Amy mentioned, we're into a very strong El Nino pattern, but we've had some good falls of rain recently and a pretty good spring so far across a lot of New South Wales. And this diagram shows that for the next 3 months, the Bureau of Meteorology is expecting that we've got a fairly good chance of having median rainfall for November through to January. But I realise there's a lot of concern out there about a dry season coming. And it's 42 degrees here today in the Hunter Valley, and it's giving us a bit of a taste of what might possibly be ahead. So the weather's always an unknown factor. This last chart just shows farmer sentiment that we gauged at the time we were collecting the data from farmers. So this is back in July, August, and just shows you the intent of farmers regarding milk production for the 15-16 year, with the majority of the farmers expecting to increase their milk or at least not to drop milk production. A bit of mixed sentiment on milk price, where the farmers expected milk price to remain the same or increase or decrease. But you can see the northern farmers are a bit more optimistic about milk price than the southern farmers. So I'll end there. As I mentioned, the full report will be available on the Dairy Australia website from Monday. So you can download it there. You can also contact me if you would like a hard copy of the report, and we'll be out presenting the reports to farmer discussion groups in the next couple of months. So with that, I'll hand over to John to give us some commentary on the results.
Thanks, Kerry. And I'm aware that Greg and Josh from Dairy Australia have a couple of groups, one at Nowra and one at Taree. I'll speak slowly because I appreciate their ability to absorb information is a bit slower than some other parts of Australia. No, only joking, boys. If we go back and look at what Kerry presented, there are a couple of really important bits of information which should have almost indicated that the financial returns would be reasonable. One is above average rainfall. So therefore we should have been able to, on a well-managed dairy farm, consume a fair bit of direct grades feed. And the second thing is that I think Kerry's figures said something like 54 cents per standard litre or 54 cents a litre and 37 cents per kilo fresh weight for grain or concentrate plus additives. So that ratio of the 54 divided by 37 gives us 1.5. So even the farms with fairly high concentrate and supplement inputs should have been able to do fairly well. So those two things really highlight the overarching conditions around Kerry's figures. The other thing I should say is Kerry and her team have got 37 sets of data together, and whilst data is dangerous, and I'll come back to that in a minute, it is a fantastic set of data, and you now have enough sets of data in New South Wales to really very clearly pick up trending in styles of farming. Now, the slide I've got up at the moment, really I just want to emphasise that the concept of interstate barriers is really a thing of the past. I've just picked out imported feed there. You'll see WA, South Australia, Vic and New South Wales. We all run, there's as much diversity within those states as between the states. So, and it's all about imported feed, milk price, cost of production, calving date and frequency. In excess of 50% of herds now calve more than once a year, so this concept of a single calving dairy herd is out the window in a lot of situations. Supplement price and seasonality of milk production. And it's interesting when we look at that range, because as Kerry said, averages really are horribly misleading. There's the range of cost of production in Kerry's data. Here's the range of cost of production in Natalie Nelson's data from epi, I'll say, in Victoria. And what runs through your mind there is, why do we have in each state we've got a $4 or $5 variation in cost of production? Now that might be serious or it might not, depending upon the farm. I just wanted to, that's a young New South Wales dairy farmer having a day off. I actually think, and I want to emphasise that, I think New South Wales is going through a rebirthing in dairy. I've been exposed to New South Wales dairy enough now that I think there's a whole new generation. They're asking questions that absolutely need to be asked. They can see an opportunity and they are putting resilience in place. And there is enormous opportunity for profit in New South Wales. Now, investigation is worthwhile, but let me emphasise, and even looking at 37 farms that Kerry gave me, I get very nervous about talking about individual farm data when I can't context it to the farm and the people and the situation. So I love collective data, I love trending data, but I'm just putting a cautionary note against that, and that applies not just to Dairy Farm Monitor, but very much to Dairy Base, which is becoming the benchmarking analysis program. And just to clarify some issues there, Dairy Farm Monitor was never designed as a benchmarking analysis program. It was always designed as an industry information program to know where the industry sits. My third point here, one of my life frustrations is when I come across people with reams and reams of printouts and figures and ratings of ROA and EBIT and a whole range of things, but they don't understand what's behind those figures. Pasture consumption is a classic. If your pasture consumption figure was much lower than you anticipated, then you need a very good understanding of the methodology of that pasture consumption figure to interpret that. Again, feed and labour. Back in our cost of production data, the range I had up there before, if you were milking 120 cows, making a reasonable living, I guarantee your cost of production would look horribly high because of the imputed labour factor. So you need to understand what's behind those figures, and to me it's the understanding is almost more important than the figures. The other reason we need some of this data, and Dairy Base again is going to support this, is that it validates direction in businesses. So if you've gone down Phil Shannon's Feeding Pasture for Profit track, and you want to validate whether you are on the right path after 2 or 3 years, then the data will help you do that. And the other thing about Dairy Farm Monitor, of course, is that it's independent data. It's not being assessed by the consultant you're receiving advice from. Now I'm just going to move to milk price for a tick, because the question always comes up, how protected are we in New South Wales? There's the price 604 from Victoria last year. Here's the price from New South Wales. It's interesting, I haven't got it up there, but your set of data varies by $2 a kilo. So milk price amongst your 37 farms varies by up to $2. Now Kerry had a figure there of $1.32 as being your profit per kilo. So the variation in milk price is greater than your average profit, which is interesting in itself. The other thing I noted was that the highest priced dairy farm is not the most profitable, which again is not surprising. So there's a $1.42 difference between average Vic and average New South Wales. So I think there's at least a buffer of $1 or 7 cents a litre, and there's no reason why that buffer should disappear. Now, if we're looking at security in an industry, that's a pretty handy buffer. However, when we look at the difference in profit, in fact, the Victorian data and New South Wales data is amazingly well aligned, but we have a cost of production difference of $1.76. Some of that is due to milk price, in terms of the profit difference. But what I'm suggesting is that there's still potential to chisel away at and question everything in the cost side. And that's what I think the new generation is doing. What's interesting with this sort of data now is these are averages, okay, but I think we've got some better guides for cost of production targets for different systems, and we've been looking for those for a fair while. Now, this slide is a little bit ugly. I think Kerry's got her pointer there, but this is my pointer, so we'll see how we go. These are 3 farms from, and they're not all in Victoria. They're scattered across Australia, and where they are doesn't really matter. Some of you will have seen these at the Australian Dairy Conference in February this year, and they were 3 very well managed dairy farms with different production systems. So if I look at my minimalist here, 700 cows, solids per cow 401, 3.8 cows per hectare, 1 calving, 60% pasture in the diet, cost of production of about $4 and a profit of $2.22. Then my steadier, which I would argue is exploiting both pasture and the supplements, but still being pretty resilient, 58% pasture in the diet, obviously pushing up the per cow productions, cost of production of $4.35 and profit at $2.32. Then we've got our cracker, which really would parallel with almost a feedlot situation, a cost of production $6.45. Now, there was a milk price differential from minimalist to cracker of $1, which is contributing to the profit sitting across here. What I did was to pull out 3 farms from Kerry's data, and I haven't put the farm number against them because it's confidential information. But here we've got what I would call the minimalist, exploiting pasture, keeping imported feed to a lower level, 56% pasture in the diet, cost of production $5.43. Now that's a pretty resilient cost of production and a profit of $2.19. Then we jump up to our parallel steadier, slide down there, higher per cows, lower stocking rate, year-round carver, 46% pasture in the diet, cost of production $6 and a profit of $2.34. And then we again jump up to an even higher input farm. And what that's really saying, and this is where the trending within Kerry's data is invaluable, is number one, we can see zones for cost of production. So that if I was sitting in New South Wales with a predominantly pasture-based system, I reckon $5 should be achievable. If I've got a feedlot type system, then I'm probably going to be sitting at $7 on a well-managed one. But there is no doubt that as we go from left to right in both series, we are increasing risk because the average cost of production will generally increase. And the important thing for farmers to say is, well, where do I sit within those? Now, general observations of the data. I've already said great range of farms. I think it's really clear that contrary to what would be a common historical perception in New South Wales, I'll say that again, contrary to what would be a common perception, simple nutritional systems are achieving high milk solids per cow with 60% homegrown feed. In other words, we do not need rocket science to achieve these levels of production and still have predominantly homegrown feed. Surprise, surprise, the top 25% are consuming 49% more pasture per hectare with efficient cows, and they're doing it at a significantly lower cost. The labour efficiencies, which has always been an issue relative to the southerners, if you like, 40% of farms achieved in excess of 40,000 kilos of milk solids per labour unit. So I actually don't look at cows per labour unit. I look far more at productivity per labour unit, because that's the blend of production per cow and cow numbers. And about 20% achieved above 50,000 kilos of milk solids per labour unit. And if you said what's a crackerjack figure, we'd say 65,000, but not many farms would be in that category. Now, the last issue which Kerry has asked me to address is, what are the farm growth opportunities? What I'd be suggesting would be that it depends whether we're talking about a top 25% farm or an average farm. If you're in the top 25% group, your profit is $2.61 per kilo milk solids, and as Kerry said, I look more at profit per kilo milk solids than I do at ROA, because ROA is so impacted by whether you're sitting on the coast or whether you're sitting miles inland. So $2.61, the only way I can describe that is crackerjack. The average profit was $1.32. That's not bad, but you had a good season and supplement prices and milk prices weren't too bad. So without talking about anything else there, the growth opportunities are very good if you're in the top 25%. And the other overriding factor in this, that I think the equity level in the data set was 76%. Now, I deal with a lot of dairy farmers in the 45 to 50% equity level, and they exploit opportunities. So what I'm suggesting is, if you're good enough, then there is enormous opportunity to exploit dairy production in New South Wales. Now, we have to, that's from an individual farm point of view. Everything I read makes me think dairy is gangbuster. Everyone is going to produce infant formula. Bear in mind, infant formula, a tonne of infant formula has only got 30% milk in it. But we have to just be cautious. And Amy has already highlighted the variation, if you like, between what's occurring on the export market and the domestic scene. So the simplistic, very simplistic way I would look at this is, if my domestic processor price is $7.60 and when I look at some of the clients I've got in New South Wales that are supplying factories that are almost 100% domestic, that's where the price is currently sitting, about $7.60. If I go onto the internet and on the 3rd of November at the last auction, there was the price of powder. And if we use our little formula to supposedly equate that to farm gate price, it's $4.85. And if I said to Amy, how does $4.85 go in the dairy industry, I think the answer might be, it won't do a lot of good. So therefore, if I've got a processor who starts expanding and creating an export market, then obviously we are going to get a blended price. And that price might be somewhere around about $6.80 to $7. So in other words, we're back to where we started, that there is opportunity for growth, but your growth has to be resilient and profitable, and again that comes back to cost of production, which again I just think is one of those really resilient characteristics. So look, I might leave it there, but there's a lot of information to pull out of Kerry's data, but unfortunately only in 20 minutes we haven't got a lot of time to do it. Kerry.
Thanks very much, John. When the three of us were planning this, we thought, gee, there's no way we're going to stick to 1 hour, but I think we have. We've stuck to 55 minutes in our presentation, so we do have some time for questions. If anybody wants to type a question in there, I know we have one for Amy, but John, I've just got one question for you on our data. Our level of concentrate feeding is, average around about 2 tonnes per cow, and our average milk production is about 500 kilos of milk solids. What do you draw from that in terms of per cow feed efficiency
Yeah, look, it's one that when you look at figures superficially, admittedly, but 2 tonne and 500 kilos of milk solids doesn't sit nicely. For 2 tonne, you know, I would be chasing 550, and I think that's just a direct reflection of how much direct harvest feed we can get in and for how long in the year. But I think it's significantly better than where historically it may have been and is gradually increasing. So, but certainly when you see figures of 2.5 tonne and 480 of milk solids, the only way that can work is at a very high milk solids price and a low concentrate price. So I think, yeah, I'm still a little bit uncomfortable with it, Kerry, but we just keep chipping away.
Thanks. Thanks. We've got a question coming through about our pasture consumption calculation, and does it include homegrown fodder crops? The numbers I mentioned were pasture grazed, directly grazed on the milking area. The way we deal with fodder crops that are cut and carry into silage, they're actually counted as brought-in feed if they're not grazed. So if they're ensiled and then fed back, the growth is recorded on the usable area, but not directly on the milking area. So, as John said, you need to really understand how the figures are calculated to be able to make proper sense of them, and that's something that we hope to explain more as we're doing some farmer presentations.
Gary, can I just come in there for a tick? The pasture consumption figure is one that I think has been under the microscope, and some have been critical of. We sat down about a week ago and ran the Dairy Farm Monitor pasture consumption figure, same set of data going through Dairy Farm Monitor, Dairy Base, and the database I use, and came up within about 0.5 tonne per hectare or 1 tonne per hectare, which we thought was pretty good. The calculation is as correct as it can be, given that it's a back calculation. We often get the question or the crit comment, probably more in your area than Kerry than ours. I'm sure I consumed more pasture than the figure is telling me. Now, if that's the case, then there are two areas that people need to look at. One is, you know, is the right information in there? Well, that's pretty obvious. The second is, I find it in a lot of situations where we are overfeeding, getting poor feed conversion, therefore it's based on a back calculation which drives pasture consumption down. And consequently, that's why I emphasise understanding the calculation, not just taking it at face value.
Yeah, thanks. And the other question about dry stock, the calculation only includes those animals that are on the milking area. So if dry stock or replacement stock do spend time on the milking area, that's taken into account. So it's basically milkers converting pasture into milk. Amy, there was a question earlier. Can you see that question about supply expected to outstrip demand?
Yes, I can see that, and I think it was a two-part question there from Peter, if I'm not correct. Let me just scroll back. So a two-part question, one about stocks and one about Russia. Firstly, about stocks, yes, there is a feel that there probably is a fair bit of stocks warehoused in various things, and there's a private storage aid program running in the EU. Where, you know, there's been the impact of things such as Chinese inventories of some milk powder that they built up while they were buying very strongly and are taking quite a while to run through. And then there's also stocks that individual companies are holding in terms of managing, managing their supply and their sales at the moment in a depressed market. So that managing their supply and their sales at the moment in a depressed market. So there's certainly an impact there, and those stocks will need to be sold at some point, and those private storage age stocks will need to be sold and will come back into the market. As far as Russia, I'm glad you asked that question, Peter, because it's an interesting one. The impact, broadly speaking, the impact of that embargo has been to displace product which otherwise would have gone into Russia. They were the world's second largest single volume market for dairy. So a significant market, and their total dairy imports have been down 71% in the 12 months of June, so a significant drop. And what that's done is displaced products that otherwise would have been sold into that market. A large amount of that product would have come from the EU. As a result, we've seen the EU offering very competitively priced product into traditionally Oceania-dominated markets. So, places like Southeast Asia, China, other markets as well. They've been competing very strongly, and they actually, the EU increased their exports into China relatively significantly in the 12 months of June. They were the only major exporter to do that. So some competitive offers coming out there, and in terms of the expected impact of them lifting embargoes, well, that would help with that supply-demand imbalance situation. But the general expectation from sources at the moment is that embargo is likely to remain in place until probably 2018. So we could be facing that ongoing situation in the market for quite some time.
Thank you, Amy. John, a question there from Juan. Do you see that one? Why is it so hard for farmers to improve past utilisation, do you think? And whilst we're up this year to 8 tonnes, yeah, we've been sitting around that 7 to 8 tonnes over the 4 years of the project.
Yeah, we need a couple of hours. I think remember, pasture utilisation is the sum total of a lot of activities, and I picture a sort of a stairway with fertiliser, PKS, and then nitrogen, and then cultivars, and then a very good human on top of that, putting it all together. I think there are some cultural aspects, and I'll throw this in because we're near the end of the webinar, but when you go to Tasmania, everything's behind a strip grazer, including young stock. That's culturally what they do. When you drive around a lot of Gippsland and Western Victoria, the milkers will generally be behind a strip grazer, but who would ever graze young stock, strip graze young stock? And then you'll go into other regions of Australia where it culturally isn't as encouraged to strip graze and look at rotation and whatever. Now that's what that crest of the wave that I was talking about is. The culture is changing. So I think it's partly historical. I think it has to be driven by the operator deciding what he wants or she wants cows to do, not the cows deciding what they want the operator to do. So there's a lot of factors in there, Kerry.
Thanks, John. There was a question there about dairy base, which Natalie's answered to a degree. Thank you, Natalie. Yeah, just on dairy base, that the tools now available on the website, and I think quite a lot of farmers are entering their data. When you do a comparative analysis report in dairy base, the data that you're comparing yourself to is the Dairy Farm Monitor data from all the states now are participating in Dairy Farm Monitor, or Queensland has their own version, QDAS. So yes, the Dairy Farm Monitor does form the benchmarking data in the dairy base, and as Natalie mentioned, our data, New South Wales data, will be going in there for this year as soon as probably in the next week or so. So farmers that participate in Dairy Farm Monitor will be able to access their own farm data in dairy base. Okay, I think we'll end it there. We've gone 6 minutes over, but Just thank you very much for your participation. This webinar has been recorded, so the slides and the audio will be available as an MP4 file that can be downloaded and played on your device. I will email you a link to the file as soon as we get it online, so it'll be on the DPI website and possibly on the Dairy Australia website, but I'll let you know about that. So thank you very much for your participation. When you quit the webinar, you'll be offered a quick survey, a click the button survey, just to give us some feedback on the webinar. So we would appreciate it if you would complete that survey. So thank you very much for your participation, and that's all for now.